That's the personal line of credit, right? You put that 483 back in your system, it's immediately able to respond again to urgencies and emergencies. Your kid gets sick, an aging parent needs help, you have a deal that comes your way, and the money got to move by Friday. So to your point, use it like a personal line of credit. If you think of it like a personal line of credit, then tap it for those urgencies, those emergencies, as well as the opportunities.
And I think that is one of the biggest differences, Jeremy, because when you're both sides of the equation, when you're wearing both hats, you have more control, but you also have more capital.
Yeah. Welcome to another episode of WealthWise Banking. I'm here today with my co-host Jason Sipple, and it's getting hot here in Florida, man. How you been doing?
It's getting hot. It's getting a little dangerous out on Lake Apopka, the trail. I saw about a 7 to 7.5 foot gator. I thought I was coming up on a dinosaur. I started filming it, but I got a little nervous, so my video wasn't so great. But yeah, it's hot, and the gators are out in the sun, my friend. So
Yeah, no, I'm seeing them too. So gators are fine. Snakes, that's a nope, nope.
you're a nope on the snakes, huh?
That's it, man. I don't do snakes. All
Learn
right.
something every day. I don't like the bugs. I'm okay with the snakes. I'm okay with the gators. Just take away the bugs. Take away the bugs.
Fair enough. Fair enough. So let's go ahead and get into today's episode. This was actually inspired by a call that you recently had. And what we're going to talk about today is really the hidden cost of borrowing money, right? So most people think that a lot of the ways that you pay for things, most expenses, you can do one of two things. You can either pay cash or you can finance it. And if you pay cash, well, now you feel responsible because you avoided interest payments, right? You avoid the
Yeah.
debtors of
Yeah.
creditors. What's the other option? You
Yeah.
finance it, right? If you finance it, you feel responsible because you kept your cash. And both choices, they feel responsible, right? Depending on who you are, which side of the aisle you're on. But here's the problem. When you pay cash, the money is now trapped inside of whatever you bought. That could be a car, it could be equipment, it could be maybe an urgency or emergency like a home repair or business expense, right? The money solved today's problem, but now how do you respond to tomorrow's problem? Because guess what? Life, as Jason talks about, life doesn't respond to your calendar. The,
No,
the
it doesn't
inevitable in
wait.
life is change.
Yeah. Yeah. Jeremy, that's good, man. So the listeners know the one thing constant in life is change. And, you've been talking a lot about urgencies and emergencies. You talked about two of the most common ways to finance things. And we try, here we're not doing things the common way, right? We're trying, we're not trying, we are showing you how you can do things and optimize your life so you're ready for that change in a bigger way. So,
Yeah. Because when life doesn't, check your calendar, right? When the kid gets sick or even an opportunity shows up or a deal needs cash today, how are you going to respond? How are you going to respond to that moment? Did you finance something previous? Are you avoiding the opportunity to earn money on your money? Or did you give up control? Are you paying interest on something? So today,
there,
Jason and I, we're going to
yeah.
walk through a simple $25,000 example. And we're going to look at the hidden cost of financing. We're also going to look at the hidden cost of paying all cash. And then we're going to look at a third way to start thinking about money and about the way your capital actually stays alive while you're using it. So, getting into it, Jason, let's make this a little bit real, all right? Let's say that somebody needs to buy a car. Everyone here has a car. Or if maybe you don't, maybe you have to buy equipment. Well, let's say you do use a car, $25,000. What do most people typically do?
Well, they're like we mentioned, they're either saving the money up, right, in some kind of account or maybe under their mattress or in a can like Daddy Dave would have you do. And then you're taking that amount of money, you're going to the dealership when they try to negotiate with you, you're like, nope, I'm paying this much because you don't want payments. You don't want to pay interest to someone else. But Jeremy, when you do that, like it feels responsible, right? Because you saved up. You had discipline, you had intentionality around it. You knew what your limit was. And then you go in and you pay cash. And Jeremy, what are you giving up when you pay cash?
You give up the opportunity to earn interest on your money, right? So the cash buyer says, hey, I don't want to do this because I don't want debt. The borrower, they say, well, I want to keep cash available. And both those decisions are responsible depending again which aisle you sit on. But that's not really the issue here that we're getting into because they don't look at what happens after the purchase. To your point, I think that's where you're going, right?
Yeah,
What's the hidden costs of
that's
what
it.
shows up?
That's it. It's what happens. And I mean, it comes down to this is a question I like to kind of put out there for you. If you're not driving, write this down. Will my money ever make money again? Right. And if the answer is no, then you might want to ask how. And that's what we're going to get into on a deeper level here. So, let's talk about the hidden cost of financing, right? So financing people, why would people finance something? They want to preserve cash. And when they do that, interest starts flowing away. So Jeremy, kind of walk through a little bit deeper what financing looks like. Simple numbers.
Yeah. All right. So simple numbers, we'll look at, like I said, a car payment. We'll say 25 grand. You have a $25,000 vehicle that you want to purchase, and the interest rate that the dealership's going to charge you is 6%. So 25 grand at 6% over 5 years, that payment will come out to be $483 a month. So after the next 5 years, you'll end up paying about 29,000. That's $25,000 in principal and $4,000 in interest. So that's pretty easy to understand, right? You need 25 grand, you pay
Yep.
back 29 grand, $4,000 went to the lender. And that can be normal, but think about that across a lifetime. And you see how that pattern adds up with car purchases, equipments, urgencies, emergencies, right? Business needs, home repairs, major purchases. And that's at a small interest rate of 6%. Think about bigger interest rates, right? Bank loans, credit card companies. The payment becomes the habit. There's
Hmm.
discipline on the repayment, right? They have discipline because they are doing the responsible thing of paying it back. The question is where that discipline keeps flowing. How much interest have you paid over your life without ever measuring the amount of interest that left your pocket went to make someone else rich?
And think about that for a second. When I had this conversation, same person, and I had this conversation multiple times recently, Jeremy, where people are just like, one guy this week was just really focused on his credit score. And I just pointed out, it's a whole different episode sometime, but I pointed out like who is like having a higher credit score is better for who? Like, yes, it might make more available to finance, right? It might give you more of a line of credit. But at the end of the day, you just talked about every time you purchase a car, every time that there is equipment that needs to be financed, emergencies, business needs, home repairs, major purchases. Every time you finance something, the money's flowing away from you, and who's actually in control of that and who's actually winning
Yeah.
in that scenario.
Right. So that's the hidden cost of financing. What about the hidden cost of paying all cash? Let's look at that, right? This is the Daddy Dave world.
Yeah.
So
And
let's talk about that a little bit.
yeah, let's talk about this. This one's a hard one. This one's an identity thing as well, I feel. And because paying cash, like I was saying earlier, it feels strong. You did the responsible thing. There's no lender involved, so no one else is making money on your money. There's no payment involved, so you're one and done. There's no interest bill. The purchase is done. You make the payment, you saved up, you scrimp save as Daddy David wants you to do. You eat beans for a long time, and then you have the money and you go and you use the money and you're really excited. And that feels responsible. And then life keeps moving. Something else happens, right? Like I always talk about, change is going to show up. A bill repair shows up. Child needs help with school, or heaven forbid, get sick. Parent needs help, right? And maybe they live in a different country, in a different city, even. A position or a business opportunity comes up. That opportunity comes up, or another deal, maybe needs cash today. And so now that money that used to be available, that you had worked so hard and put so much time and effort into building up, is sitting inside the thing that's parked in your driveway.
Mhm.
That's the hidden cost.
Yeah, you avoided interest, but you gave up access and you interrupted growth. You lost the ability to earn interest on your money. So if that same 25 grand, let's say that it was put in something safe. Let's say that it's put in something safe earning 4% over that same 5 year period. That would grow at 4% to $30,400. So
Yep.
that's $5,400 of growth. That's the bigger issue though was access that we talked about, right? That the money was tied up in the actual purchase and it's no longer able to respond to life. So ask yourself, have you ever paid cash something to avoid interest and then wished you still had access to that same money later on?
I mean, it's almost, have you ever paid cash? Like maybe a harder way or a deeper question, Jeremy, would be, have you ever paid cash to avoid the interest? And then, you have within a day or two, I think it's buyer's remorse. All of a sudden you're sitting there and then life happens, an actual emergency comes up. You got the thing you wanted and now you really need the money and now you're stuck,
Hmm.
right?
Yeah.
You're wishing, man, I wish I had that money back, basically. And
Yeah.
so
And that's because a lot of the money only has one job, right? Most people only allocate one job per dollar. And that's where we want to introduce today a third path, right? A path of living capital. So what do we mean by living capital? What is living capital?
Living capital is where the money's positioned to stay accessible. It keeps working for you. Like you just said, I mean, living capital, simpler than what I was about to say, is you always are told, hey, don't go work harder. Have your money work harder for you, right? Like work smarter, not harder. And when you have living capital, it means that now the money's positioned to stay accessible. It keeps working for you, like it's never interrupted. And it's there to help you when the one thing that's guaranteeing life happens, change.
Yeah.
And that way like we were talking about, money has one job, or most money, most people, if you're on the borrower path we talk about, they're you're looking at a way where your money's only doing one job. When you spend it, it's gone. Right? You're back to the zero line, as Kiyosaki says. If you save it, you hesitate to use it because you know when you spend it, you go back to zero. If you invest it, now you're taking on risk. You might be exposing yourself. It might be hard to access if you need that capital back, whether it's in real estate equity or in a retirement account, or even if you go into a joint venture. And when that thing that you invest in stops working and you need that capital back and you don't have access to it, guess what? Things can feel pretty uncomfortable.
Yeah. So living capital really has multiple jobs. That's what we're getting at. The multiple jobs. So what are they? What are the multiple jobs of living capital? Well, it's liquidity, it's growth, it's protection, it's control, right? So one of the best ways that we create living capital is through a properly designed, high cash value, whole life insurance policy. And I want to say that very clearly. All right. The conversation that we're having today, it's really about capital control. The policy is the tool. It's what makes the actual structure possible.
Yeah.
So the vehicle, the wrapper is the policy, but what we're really talking about, the living capital piece, that's about that growth, liquidity, the protection, the control. That's what we're doing to create a third option for our money.
And this option is one that people think's too good to be true, right? Like something has to be wrong with it. And so for you, just think about this question. Is your money doing multiple jobs, or is your money stuck only doing one?
Mhm. So let's talk about how that policy loan actually works. So how do we use living capital for the exact same thing? Okay. So the way that it works is the insurance company lends against the cash value. That becomes the collateral. What that does is allow the policy value to continue working, continue growing, to continue compounding. So in a simple version, the way that it works is you build cash value inside of a policy, and that cash value becomes accessible to you. When I say accessible, 30 days. The first 30 days of you starting the whole thing, that's when it becomes accessible. When you need capital, the insurance company is going to lend against the cash value and use it as a collateral. And then you use that capital for the actual purchase and you'll repay it back like a personal line of credit. Treat it like a personal line of credit. The same discipline that you had when you financed it, you'll be financing it yourself. At the same time, the cash value continue growing and compounding. So this is key. The $25,000 and never left the policy. It still supports the purchase. It just simply served as the collateral. So the
Yes.
policy kept working. It kept growing. It kept compounding. The loan handled the purchase. And that's how the dollar has multiple jobs. It went to go purchase the car. The opportunity was the compounding growth inside the policy. You also had a third job because the wrapper is a whole life insurance policy. The third job is protection, protection for your family, for your business. So, what would actually change if your money could keep working while still helping you make major purchases in life? If you had the ability to have assign multiple jobs at the same dollar, why wouldn't you do that?
And I love this part, Jeremy, and that was so powerful. We're going to look at this. The math is not difficult here, okay? This is simple enough to remember. So let's put all three side by side, Jeremy. Let's go through the whole thing on you need $25,000 to make this purchase, right? Option one's paying cash. Again, you're avoiding interest. The money's tied up in the purchase, whatever it is you purchased, the vehicle or whatever. You lose access to the money and you miss the $5,400 of potential growth over 5 years at 4%.
And that was at a simple 4%, right? Yeah.
Yes.
So
Yes.
what was option two? Option two, we covered finance it. So you kept your cash, you're paying that $483 a month, but you're going to repay 29 grand. 25,000 went to principal. The other 4,000 went to the lender. That went to the interest that was owed. So option one was pay cash. You missed out on $5,400 of growth.
Hmm.
Option two, you financed it. $4,000 went to interest. Option three is the living capital approach that we're talking about.
Ooh, this one's fun. This is the good one. Here's the good stuff, Jeremy. So bring us through option three.
So in
Alternative
option
way.
three, yeah, so option three, you have the $25,000 of cash value. The insurance company lent against it, and you still made the same $483 a month repayment. So you're going to pay back $4,000 in loan interest, but because the compounding growth in the capital inside the policy, that 25 grand still grew to 30,400. So the difference here is $1,400. You had $5,400 of growth, $4,000 of interest, but you made out $1,400 ahead. And that does not even include dividends because the carriers we work with give you dividends. They've been given dividends every single year consecutively for over 100 years. So not only did you get $1,400, you also got access to dividends tax free.
Same dollar, multiple jobs. Like this is how you make your money smart. Are we making money smarter, Jeremy? Is that what we're doing here?
We're using money smarter, right?
Oh, we
So
didn't
that's
make
what
money
we're
any
doing.
smarter.
No. And one other thing that I forgot to mention there, you still had protection because the wrapper
Yeah.
is a whole life policy. You also had protection for your family that
And can
pays
we
out
bring it
tax free.
can we bring it a level deeper too? That $483 that is flowing back into your system, right? Remember where in the example of my client where that was flowing out to a credit union, that'll be another, I've talked about this before, but it was flowing out. And once that 483 leaves, not only is it not ever making him any money again, but it's also left his house or left his house forever. There's no more access to it. When you're being a responsible banker and paying yourself back, just like you would the traditional system, all of a sudden, every time that 483 goes in there, it stacks and stacks and stacks. And that's what's available for those urgencies and emergencies. Because all of a sudden, you have the thing that you bought, you have guaranteed growth, you're most likely going to earn a dividend, you have protection, and guess what? You have capital coming back to you for when life happens.
Yeah. That's the personal line of credit, right? You put that 483 back in your system, it's immediately able to respond again to urgencies and emergencies. Your kid gets sick, an aging parent needs help. You have a deal that comes your way and the money got to move by Friday. So to your point, use it like a personal line of credit. If you think of it like a personal line of credit, then tap it for those urgencies, those emergencies, as well as the opportunities.
And I think that is one of the biggest differences, Jeremy, because when you're both sides of the equation, when you're wearing both hats, you have more control, but you also have more capital,
Yeah.
right? More control, more capital. That's the bottom line here.
Yeah. I do want to address one thing though. So we do have folks out there that say, hey, if I put my money into this policy though, I may not have every single dollar available right away.
Mm,
How should they think about that, Jason? Because it is a true statement, especially in immature early on policies, you're not
yeah.
getting dollar for dollar match. So let's talk about that. Because it's a fair thing to understand here and why that's important.
Yeah, it's really fair. It's really fair because and it comes from your perspective before, it comes from your perspective. You're coming from the perspective that I need it now, right? The now society, the big red easy button. It's like, I need it now. I need it immediately. And I think about my life. My life, financial life breaks down in hours, days, weeks, and months. We're not looking at what it is over 5, 15, 30 years. So it's a fair statement, but the early cash value may be less than the premium paid in, right? You don't have 100% access immediately. The difference is that money is doing something else. Part of the premium correct creates the accessible cash value when it's designed correctly, as we do. And part of it is the protection piece, right? You're buying immediate protection for your family. And
Yeah.
so that if protection matters, and even if it doesn't matter, actually, Jeremy, it means that either your family and the people that you love or the things that you care about are going to get a tax-free death benefit. And it also creates liquidity at that same exact moment. So it's protecting your family or your business or other things, right? So your dollars are doing multiple jobs, which is why you don't have full access because you have the immediate cash value, you have the guaranteed growth, you have liquidity, you have protection. And that's why this policy design, this is why it has to be specially engineered for that high liquidity for you to be able to use it the way we're talking about it.
Yeah. And then to be a caveat here, that is only the first early years. That's typically the first 3 to 4 years. After that, typically in year 4, 5, 6, you're seeing a dollar of premium funded into the policy with an increase in cash value greater than that same dollar. So
Yes.
to Jason's point, early on is your mindset. If you look at it as I'm getting cash value, liquidity, and protection, it's an incredible asset. And then you get more and more cash value than premiums funded into the policy as the policy matures. It's one of the reasons we like to put these on children, to be quite honest. If you think of a lifetime of compounding growth on a child, I mean, we talked about it in a previous episode. She was getting $500,000 of cash value growth per year in her passive income years because we started on a 2-year-old. I
Yeah.
mean, you allow compounding over time. I don't care what the markets are doing. I don't care what emerging markets are going to be in the future. If I look at that amount of protection that's able to absorb life's changes, market changes, right? That amount of protection doesn't just show up in death benefit, it shows up in everyday living capital.
Every day. And it's like Jeremy, like when you're looking, and we're talking about tax-free capital too, right? Like that's a big piece of like Jeremy, if you hand me $1 and I handed you like later 3, 4, $5 back every time you handed me $1, how many dollars are you going to give me?
I'm going to give you as many dollars as I can, right?
And that's what we're talking about. And that is like what Einstein calls the eighth wonder of the world, uninterrupted compound interest. And Jeremy, this is the only vehicle that I know of that you can have uninterrupted compound interest plus using it like a line of credit, like we're talking about.
Yeah. So there is something that's got to be, I want to not overlook here, right? Discipline is required in this entire equation. So this works best for who, right? For people who follow through.
Yeah.
If in this scenario, in this specific scenario, if someone can pay a lender $483 a month for 5 years, the same discipline that would go out to pay the debtors and pay the creditors, that same discipline can be brought back into this system because the payment habit is already there, the behavior is already there. The question is, where does the payment actually go? If you have the discipline, well, when you're using the policy like a line of credit, that policy, that money goes back in with the same seriousness, the same discipline. The system becomes available again for the next use. It's there to respond to life's urgencies and emergencies. It's one purchase at a time, one repayment at a time, one controlled decision at a time. That's the pattern. If you have the discipline, the Jason also you calls it money patterns. If you have the proper money patterns, this works wonderfully. If you're not a disciplined person, this isn't going to work for you. Okay,
Yeah.
let's just put it plain and simple. I don't want to, tell you that it will if you don't have the proper money patterns to implement this. But if you're already someone who makes their payments to debtors and creditors on time, instead wants to redirect that into living capital and give your family and your
Mm,
business protection, now we're talking about building steam. We're talking about building up momentum.
mm.
That's how you get that tax-free growth over time, that compounding.
Yeah. Mm. That's what I have to say to that, Jeremy. That's a secret sauce. Well, you identified something that you just kind of unlocked something for me and maybe unlocked something for a lot of the listeners. When you have had a pattern of paying consistent and persistently to your finance things in your life, vehicles, homes, credit cards, etc., you're not late, you have a very high credit score, you're very proud of that. When you have that pattern, as long as you take that same discipline you have and realize that this is not something that is going to be an overnight fix, right? This takes time to make a pattern switch, but you start with one thing, you implement the pattern there, and over time you shift all the things that used to have money flowing away from you, all of a sudden you control and you have all the things we're talking about. You can use the same pattern you have, you just have to reposition your thinking to the next part, right? Because how does the borrower think about the payment, Jeremy?
So the borrower thinks about the payment in this way, right? The borrower asks, "Hey, what is the payment?" We also talk about the builders. We have builders in our community. The builder starts asking, what is my money actually doing while I use it? And that's kind of that shift. For this $25,000 purchase, right? It was the same $483 a month, same 5-year period. The difference was one path spends cash and gives up access. They gave up control. The other path actually sends interest to a lender, right? So we talk about the all cash, we talk about the interest, the financing piece. But the third path, the living capital path, that lets capital keep working while the purchase happened, right? So over one purchase, the difference may look small. But when we're talking about a lifetime of purchases here, that's going to change things. When we're looking at cars,
Huge.
equipment, business needs,
Yeah.
right? Emergencies, college, the down payment for your house. I mean, so many times I've talked about using these policies to finance all of my real estate. It goes from one small thing, like a little snowball of money, to an avalanche of wealth if you stay consistent and persistent. Carry those same money patterns, just start prioritizing yourself. That's what we're
Man,
talking
Jeremy, you just made me wish I was your age for a moment. You know that, brother? Think about this. You know how many cars, I know this is not our trivia edition, which you'll have heard our trivia edition, but how many cars does a person purchase over a lifetime on average in America? Do you know? Do you remember?
Well, if I'm just thinking a person purchases a car every 5 to 7 years, they start driving at age, call it 20. They might stop driving when they're 80.
Well, that
I
would
don't
be
know, probably
12.
seven
Yeah.
cars.
No, somewhere between 11 and 13. So if
Okay.
let's just use 11, easier math, right? How much flowed away in the example we used for $25,000 today? It was 4 grand, right? That flowed away over 5 years at 6%. Times 11, $44,000 just came back to your system. Because remember, you made $1,400 when you plus dividend when you controlled it. Hopefully, I didn't confuse anyone, but the math over a lifetime becomes absurd.
And that's off that one small purchase, right?
That's off of one, and it's not a big purchase. If you're buying, I saw two Lambos yesterday, a convertible black one and a red one, where I was out walking around Winter Garden last night. And guess what? The kids were taking pictures. I'm like, hey, there's another red one over there. I wish I had a card right there. I wanted to put it on the card, say, hey, do you want to know a better way to have living capital? Buy this. That's what I thought, Jeremy, last night. So
Yeah. All right. So we're kind of running this one long. I like that story, but yeah, if you look at just the car purchase alone, then the equipment purchases, college, right? All those things, 44,000, 50 grand, 60 grand. If we're looking at now recapturing hundreds of thousands of dollars over our lifetime at the same time, tax free and purchasing more protection that when we start different episode, but when you start layering trust structures into it, passing on generational wealth, your family would never need or want for money ever again. Um, for this one though, staying focused, right, on that 25 grand, again, you can pay all cash. Paying all cash, it's important. It's a good idea, right? Because it avoids interest while not, or while trying to take that money and you're using it in the purchase. But if you pay all cash, you lose access, you lose flexibility. And that 4% over 5 years, you also missed out on $5,400 of growth. And then the opposite side, the other side is, well, I'm going to finance it, right? I'm going to finance it at 6%. I'm going to do that for 5 years and you'll pay $483 a month. You'll eventually pay 25 grand back on the principal and $4,000 is going to go to a debtor or creditor. If you use living capital, option three, the option that most people don't walk through because they don't realize it's an option, quite frankly. If you use a properly designed policy to actually purchase this, you run it through your system, you're still going to repay the loan. You're still going to pay the interest. But that $25,000 of cash value may continue growing inside the policy. And we're just saying at a simple, very easy to understand, I pay six, I earn four, even that gets you ahead of $1,400. So you had $5,400 of growth, right? Minus $4,000 of loan interest. That's $1,400 ahead, not even including dividends, not to mention you had protection for your family, your business, the charities, the foundations that you care about.
I love having our cake and eating it too, Jeremy. So if this made sense, look at the major purchases already coming up in your life, right? Whether it's cars, equipment, repairs, business expenses, emergencies, opportunities. Again, this is your opportunity fund. And then ask, how many times will I repeat this pattern over the next 20 years? Go to wealthwisebanking.com, schedule a call. We're going to look at how you currently handle your purchases, where your liquidity sits today, and whether a living capital strategy could help you create more control over time. The purchase is going to happen either way. The payment is going to happen either way. The question is whether you keep the money working while you use it.
Yeah, so that's pretty key, man. We'll go ahead and wrap this one up. We'll touch base with the audience next week, but until then, you're already in banking.
You're just not the banker yet.
We'll see you next week.
See you next week. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.